Why the IRS suddenly wants more information about your crypto. Most people who own crypto think of it the same way they used to think of cash under a mattress. Private, hidden, theirs. But right now in 2026, that assumption is costing people real money. And for some, it's costing them a lot more than that. The IRS has been quietly building something for years. A system, a data pipeline, a way to see exactly what you did with your Bitcoin, your Ethereum, your altcoins, and every trade in between. And starting with your 2025 tax year, that system is now fully operational. This isn't a rumor. It isn't speculation. It's happening right now. And if you own or have ever owned crypto and haven't been reporting it correctly, you need to understand what's changed and why the IRS is suddenly asking so many questions. Let's start at the beginning. For most of crypto's history, there was a massive gap in reporting. When you sold a stock, your brokerage automatically sent a form to the IRS called a 1099-B. It reported what you sold, what you got for it, and what you originally paid. The IRS had a record before you even sat down to file your taxes. Crypto had no equivalent. Exchanges were not required to report your trades to the federal government in any standardized way. Some did. Most didn't do it consistently. And millions of American crypto investors either didn't know they owed taxes or quietly chose to stay quiet and hope nobody noticed. That gap is gone now, completely. Starting January 1st, 2025, brokers like Coinbase are required to report the gross proceeds from your crypto sales and exchanges to the IRS on a brand new form called the 1099-DA. That form, the 1099-DA, is essentially the crypto version of the 1099-B that stock investors have dealt with for decades. And just like stocks, a copy goes to you and a copy goes to the IRS at the same time. Coinbase. By mid-February 2026, you should have already received this form from any centralized exchange that is required to report your 2025 crypto sales. If you traded on Coinbase, Kraken, Gemini, or any major US-based centralized platform, there is a very good chance the IRS already has data on what you sold last year. MetaMask. That's the first thing most people don't realize. They think tax season is the only time the government looks at their finances. It's not. The information arrives at the IRS before you even start filing. Now here's where it gets more serious. Form 1099-DA has no minimum reporting threshold. There's no floor. It doesn't matter if you sold $50 worth of Ethereum or 500,000. If it happened on a covered exchange, it got reported. A lot of casual investors think small transactions fly under the radar. They don't. Not anymore. Chainwise CPA. Think about someone who bought a little Solana during the bull run, forgot about it, and sold it 2 years later for a few $100s in profit. They never thought of themselves as an investor. They didn't keep records. They didn't report it. And now their exchange has already sent that transaction directly to the IRS. The mismatch between what the IRS receives and what shows up on your tax return is exactly what triggers an automated notice. It's called a CP 2000 notice, and it's one of the most common ways crypto tax problems start. The IRS compares your return with exchange-reported data and issues a notice showing unreported income. That notice comes with a bill, and if you ignore it, things escalate. Tax law advocates. Failure to file or failure to pay penalties can add up to 25% of your unpaid balance, plus compounding interest. And if the IRS determines that the underreporting was willful, the number jumps to 75%. In extreme cases, you could face up to 5 years in prison. Now, criminal prosecution is reserved for the most egregious cases, but the civil penalties alone can turn a modest oversight into a financial disaster. Tax law advocates, Optima tax relief. Let's talk about what the IRS actually knows, because this is the part that surprises most people. A lot of crypto holders believe that because their wallet address is just a string of letters and numbers, they're anonymous. That's not how it works. Every US-based crypto exchange that operates legally must collect Know Your Customer information and report user activity to the IRS. The moment you connected your identity to a verified account on an exchange, your anonymity on that platform ended. Countify. And the IRS isn't just using exchange data. In March 2021, the IRS launched Operation Hidden Treasure, a joint initiative between the Office of Fraud Enforcement and the Criminal Investigation Division, with the explicit goal of finding unreported crypto income. This wasn't a small effort. They hired specialists. They trained agents on blockchain analysis. They brought in outside technology firms. IRS National Fraud Counsel Carolyn Schenck put it bluntly at the Federal Bar Association conference. These transactions are not anonymous, and the agency can see them. Count DeFi, count DeFi. That's not posturing. The prosecutions have backed it up. Now let's talk about what's happening in 2026 specifically, because there's a second wave coming that even people who've been mostly compliant need to understand. Starting in tax year 2026, brokers will be required to report not just gross proceeds, but also cost basis to the IRS for covered digital assets acquired on or after January 1, 2026. CoinTracker cost basis is what you originally paid for an asset. It's the difference between what you made and what you owe taxes on. If you bought Bitcoin for $8,000 and sold it for $30,000, your cost basis is $8,000. Your taxable gain is $22,000. Without cost basis data, the IRS only sees the $30,000. And if your records are incomplete, you might end up paying taxes on money you never actually gained. This is important for a specific reason. In 2025, exchanges were only required to report gross proceeds. Many of those 1099-DA forms that went out earlier this year showed only the sale amount, with no cost basis attached. Many of those forms are incomplete or inaccurate. That creates a dangerous situation. Some people are going to look at their 1099-DA, see a number, and assume that's their taxable income. It might not be. If you bought crypto for $12,000 and your exchange is reporting $20,000 in proceeds, you don't owe tax on $20,000. You owe tax on the $8,000 gain. But if you don't have records proving what you paid, you're going to have a hard time defending that position. This is why documentation is no longer optional. It never was legally, but the enforcement mechanism wasn't there before. It's there now. Under the IRS's digital asset basis rules, you're now expected to maintain cost basis records on a per wallet or per account basis, rather than treating everything as one combined pool. That means if you bought crypto on Coinbase, moved it to a hardware wallet, then sold it on a different exchange, you need records connecting those dots. The receiving exchange doesn't know what you originally paid. The IRS will have a gap in their data, and that gap becomes your problem if an audit ever comes. MetaMask. Let's talk about the question on your actual tax return, because this one trips people up more than almost anything else. Every U.S. taxpayer must now answer the digital assets question on Form 1040. It's right there at the top of the form, before you even get to income. The question asks whether you received, sold, exchanged, or otherwise disposed of any digital assets during the year. And answering no when the answer is yes is not a gray area. Answering no incorrectly is considered a false statement under penalty of perjury. Tax law advocates. Tax law advocates. A lot of people check no by habit. They flip through the form, they see the question, they don't really process it, and they check no. And if their exchange has already reported transactions to the IRS, that mismatch is a serious legal problem. Now let's talk about the transactions that people routinely forget to report, because this list is longer than most people expect. Trading one cryptocurrency for another is a taxable event. This one surprises almost everyone who's new to the space. Every crypto-to-crypto trade is a taxable event, even if no cash changed hands. If you traded Ethereum for Solana, the IRS treats that the same as if you sold the Ethereum for cash and then used that cash to buy Solana. You owe capital gains tax on the difference between what your Ethereum was worth when you got it and what it was worth when you traded it away. TFD tax lawyer. Think about how many of those trades happen in a single active year. Someone who's actively trading in the altcoin space might have hundreds of these events in 12 months. Without tracking software, reconstructing that history is nearly impossible. Microtransactions, NFT sales, and what investors call test trades still count as taxable events. There is no de minimis exemption for crypto, the way there is for foreign currency transactions. Everything counts. TFD tax lawyer. Staking rewards, mining income, airdrops. These are all treated as ordinary income by the IRS, taxable at the time you receive them based on their market value at that moment. Failing to report staking or mining income is one of the most common issues the IRS is currently flagging. TFD tax lawyer. And here's the one that's catching a lot of long-term holders off guard right now. Unreported activity from prior years is now surfacing through data matching. The IRS has gone back and subpoenaed records from exchanges going back years. If you had an account, if you traded, if you cashed out back in 2020 or 2021 during the last big run, and you didn't report it accurately, that data may now be sitting in an IRS database waiting to be matched to your return. TFD tax lawyer. The IRS can audit crypto transactions up to 3 years back in most cases, but up to 6 years or more if there's substantial underreporting or suspected fraud. So the 2021 bull market, when a lot of ordinary people made their first serious crypto money, is not outside the statute of limitations for everyone. Optima tax relief. Now, what do you do if you're behind? The IRS does offer paths forward for people who haven't been fully compliant. Voluntary disclosure is one of them. It's not painless, but it's significantly better than waiting for the IRS to find you first. Taxpayers can consider offers in compromise, installment plans, or voluntary disclosure, but professional help is strongly recommended due to the complexity of crypto reporting. Optima tax relief. For the people who are current and just trying to stay that way going forward, here's the practical checklist. First, make sure you have records for every transaction across every platform you've ever used. Not just this year, every year going back to when you started. The IRS can look back, and you need to be able to look back just as far. Second, use crypto tax software. Tools exist specifically to pull data from exchanges and wallets and calculate your gain and loss position across every transaction. That's not a luxury anymore, it's a necessity. Third, review any 1099 DA forms you received this year carefully. The IRS has acknowledged that 2026 broker-reported acquisition dates and basis figures may not match your own records, so you should compare them carefully instead of assuming the broker statement is complete or accurate. If the form is wrong and you file based on wrong numbers, the error is yours to defend. Our tax partner. Fourth, report on Form 8949 and Schedule D as required. An individual must separately report digital asset transactions on Form 8949 for sales and other dispositions of capital assets. That form feeds into Schedule D, where your total capital gains and losses are calculated. Farrell Fritz. Fifth, if you use self-custody wallets, understand that you're still responsible. Using a self-custodial wallet like MetaMask doesn't exempt you from U.S. tax rules. Your blockchain transactions are public and traceable, and taxable events still need to be reflected on your return. MetaMask. And there's one more thing that's worth knowing about right now because it's happening and it caught a lot of tax professionals off guard when it first surfaced. In early 2026, a new IRS examination document came to light after a tax attorney published details of it following receipt on behalf of a client in an active audit. Based on that document, the IRS appears to be issuing an information document request during crypto examinations that requires taxpayers to disclose, under penalties of perjury, every exchange, wallet, and DeFi product they have ever used, from their very first digital asset activity onward. Count DeFi. That is not a narrow request. That is the IRS asking you to reconstruct your entire crypto history, under oath, in a formal examination. If your records aren't in order going back years, that kind of request puts you in an extremely difficult position. The IRS isn't treating crypto like a fringe asset class anymore. They have the data infrastructure. They have the enforcement tools. They have the mandate. And beginning with the 2025 tax year, they have a direct, standardized line of reporting from every major US-based exchange straight to their systems. The era of crypto being treated like something outside the tax system is over. It ended quietly, and a lot of people missed the announcement. If you've been compliant, keep your records clean and stay current with the new Form 1099 DA process. If you haven't been fully compliant, the conversation you need to have is with a qualified tax professional, not later, but now.